S&P 500 breaks a critical level. Semiconductors have their biggest drop in 3 years. SMCI is down 23%. Healthcare and financials are starting to finally see a bid. How to stay in option trades longer. What a stock market crash actually looks like. How to differentiate between a crash and a correction. Equity risk premium and why you need to watch this extremely carefully right now. Smart money, dumb money, and what it's telling us about what's about to happen. Welcome back, everybody. We have a lot to go over, so we're just going to jump right into it. Now, in front of us is a chart. Equity risk premium. And this is from Sentiment Trader. Now, I just want to walk you through how to look at this. Anything above the green line is considered very optimistic. Anything below this is considered very pessimistic. And there's a different way to look at this. And I wanted to show you the zero line right here. And for a second, we're just going to pop in a line so that you can see it. And I think it's important just to note this line. So that's your zero line coming straight across. We're just going to make that super bright. Now, before we go any further, I want to talk about what this is. And you have seen parts of this during the week where we've talked about earnings yield, we've talked about the 10-year treasury, and this is it combined. But let me give you the exact definition. So when they constructed this, this is how it's set up. Earnings yield on the S&P minus the interest rate of the 10-year treasury note. So you have the earnings yield, which is calculated by taking all the earnings of the S&P, as we note before, because we've talked about this. And then what you do is you minus the treasury note. So if the earnings yield is 4, and then you minus the treasury yield, and that is 4.6, you get negative 60. The higher the risk premium, the more attractive stocks are. So in other words, if the earnings yield, let's say, was 5, and the interest rate was 4, and you're at 1, that's higher than negative 0.60 basis points, right? All right, so the more attractive stocks are to bonds. So this is what was driving us. And it's really important to get this because this was a macro issue as well as a fundamental issue that was driving the market. So right here, you have your little level, right? And this is really important to get. And then you have November here, and this is where Itchy came out and said, we're not going to raise rates anymore. And then all of a sudden we started pushing. All right. So as we start pushing higher, okay, we are expecting a couple things to happen. Number one, we have the technicals, right? The third leg of the stool. We have the fundamentals. Earnings are getting better. We have the second leg of the stool. And we have the macro picture, which is better because why? We're increasing. And as we increase off that zero line, it's getting cheaper, right? It's actually getting cheaper to buy stocks based upon the earnings. So what's transpired is that the equity risk premium is dropping, which means it's getting worse. And we recently crossed that zero line. Now, if you look at when we crossed that zero line around March 1st, well, that's when we really started having issues. We're going to drill into this in a moment. But why does this matter and why do you care? You care because we talked about this on Friday or Thursday as well, Friday in the public video when we do the live streams, but also Thursday. Pension funds are going to pay attention to this. They're going to pay very close attention to this. So you'll remember this article that we showed the other day, actually on the 18th, yesterday, Friday at the time of recording this, where pension funds are pulling out hundreds of billions from stocks. So that's why you're seeing everything go down. So what can we do to figure out when pension funds are going to stop pulling money out of the market? And I think that this is important. First, usually by the time they're running these articles, the majority of it's already done, right? Because that's how fast it happens. But you're still going to have some leeway to it. So when you look at this 3-year chart, it's hard to get into the minutia. But now we know what we're looking at. We know who's selling and why they're selling. Why take the risk? That's why it's called equity risk premium. What is the premium that you're getting? Right now, it's negative 0.46. Well, that doesn't sound very good, does it? So what we want to see is how has this been playing out? Let's just drill into different time frames. So if we drill into different time frames, we're going to notice a couple things. Number one, straight down, and why we were dropping after we built up over here, what happened? Well, we started to go down. When did that happen? Right around that July time when Japan stepped in, if you remember, and they said they might have to raise their rates. And then you can see when we said we're going to do what? We're going to stop raising rates. And then the market just took off. And that's because you had the equity risk premium and we walked through it. So this is on a year. And then you can see from that date, January, but we were still above the zero. So it still made sense to do it. Now, if you start looking at it, you can see the break of the zero, the return, and over the zero. Now, what's fascinating to me, maybe you'll find it fascinating, is most newer traders, when did their trades not really start going well? Well, right around here. Well, what started happening? Well, institutions were selling to retail. And retail just didn't know yet. And we didn't know the extent of it. And then you can see how that picks up. But if we start looking into different time frames, we're going to note that we're already starting to see a little bit of a change. Not a big one, but a little one. Now, if we note the equity risk premium, we're going to note this on a 6-month chart, and we can obviously see this much, much clearer, right? From November 1st on, and then you see the turn in January, but we're still above that zero line. So as long as you're above that zero, what are you getting? You're getting equity risk premium. You're getting a premium for taking equity risk. It's not rocket science. And so here's the zero line. Where do we cross? Where do we all become less smart with our trades? Go look at your trading P&L on the high of your account. I would almost mark that most newer traders are going to have an issue that fell off right around here. And this is when it got harder. Why? You're fighting the tape. Why? Because your equity risk premium went away for pension funds and institutions. You and I don't care about the equity risk premium. We're not going to go out there and buy the 10-year, but if you're a pension fund like CalPERS and you have certain assumptions that you have to meet, why would you take the risk if you're not going to be given a reward for it? Does that make sense? Please comment below. I really want to make sure that I'm getting this across. And if we take a look here, what are we getting? All right, now we're getting what? Bonk, bonk. So we're getting to the point with, even with it dropping, what are we getting? We're starting to get a little bit of a turn. So that's not the best thing in the world, but it's better than the stick in the eye. And it's a start. And if we look at this in greater detail, we can see that it's really starting to hammer in there. Now, you can always calculate this self, and you can go back and look exactly how to calculate this. And it's relatively simple. You're just taking the earnings yield of the S&P and you're minusing the 10-year. If you look at those two numbers and you just type in Google S&P 500 earnings yield, it'll pop right up. And why this is important is you could say, oh, there's risk in the market. It's getting tighter. It's getting less. And we can go from there. If you want, I can also keep showing these periodically. It depends on how much value people find from it. I find it fascinating because you can determine exactly when things got hard versus when things got, easy for us. And I think that there's obviously a distinction to it. And the question is, what's going to turn it around? We're going to get into what's going to turn it around. And now we're going to look at some technicals that you could start utilizing. But first, you have to understand what the actual problem is. And retail, you and I are not going to be able to stop pension funds if they want to sell. We're not going to be able to buy that amount of equity. In front of us is smart money, dumb money. And we have seen this several times recently, and we have an update. So I want to go through the update. And for those that are newer, we don't refer to this as smart and we don't refer to this as dumb. We refer to this as institutional and we refer to this as retail, and there's a reason for that. And let's get into it. So the way that smart money is calculated, it's based upon institutional assets and institutional asset investment vehicles, such as more larger orders on the futures market, where dumb money is more calculated by odd lots in options and also by ETFs, which institutions wouldn't exactly do. Smart money, dumb, let's refer to it as retail and institutional. And I think that's very helpful because then you can equate it with what is moving which way, so you know who's investing in the market. And I do find that very helpful. But again, this is from Sediment Trader and they break this down. And what I want to point out is just be Captain Obvious here for a moment. What you're seeing is when retail, or quote, dumb money gets out of the market goes down. This is a 3-year smart money, dumb money confidence chart. And so when smart money goes up, the market drops. So as the market goes higher, or as smart money goes higher from here to here, and you mark off what's happened, market goes lower. So they're buying as the market's dipping, right? And then when your peak investment and you're dropping off, you need these spreads. You have to watch the spreads. That's really the rub. And we've gone through this ad nauseum, where you've peaked here in November and May, only to roll all the way down from July, August, September, October, November down to here, and then you've exploded to the upside. The rub with this, and the important part of this, is that the peak is an issue, but it's the break that makes the issue. The peak is an issue, but it's the break that makes the issue. For example, if you look at when we got weak here, it was the break, it was the break. That's when we got weak. And that's not even the deep part of it. The deep part is you have to watch the spread between the two. Because as long as smart money and dumb money are keeping the same distance apart and moving together, you're fine, because one's eating supply of the other. It's when the spread changes that you start running into issues, and we'll get into that. But what I want to focus on here is just be clear that if smart money is dropping, then we're going to do what? We're going to go higher. If smart money is dropping, we're going to go higher, okay? If dumb money is dropping, we're going to go lower, all right? So now that we have the basics done on that 3-year chart, we're going to go into a 1-year chart. And we're going to notice something right off the rip with this chart. We're going to notice that as dumb money drops, or retail drops, the market drops, as we talked about. And as institutions buy, we can see what happens. But once we start declining and then start rallying again, and smart money selling and dumb money's buying, right? Or retail's buying, what happens to the market? Market goes higher. So that's why I don't like to call it smart money or dumb money. meaning institutions are getting out in here and retail's fully invested, and retail caught the entire move where institutions were basically underfunded, right? So who do you really want to be? And that's important. And you want to watch the discrepancy on these terms. So once all this stuff's calculated, you can start using it to your advantage. But I want to do this recap because I waited for the data to come out because I got asked for the update before, and I wanted to show this. This is the first signal that we have gotten, any signal that we have gotten since we've crossed that you are seeing retail come in the market. Now there's some other data too that I'll show, but this is a pretty interesting sign that at least you went flat for a day or two with smart money, right, still being bought on the way up. And now we're seeing us on the smaller side, the retail guys, us saying, hey, you know what? We're just not selling right now. And I think that's pretty interesting. And I actually started to even see that in the community today where guys were just like, that's enough. I want to buy for a longer term. I'm going to put some away. I'm not calling a bottom. I want to be really clear about that. I'm showing you a data point on a chart. And now we're going to overlay this into a spread so then you can utilize the spread in a much clear and concise way. And we talked about this for some time. We've been talking about this for months, that this is the longest that you've been under this line. And usually under this line is not the problem. The problem is what with this? The problem is when you break up and you start heading up, meaning that's what you want to look for. So you're always trying to identify like what is the issue, right? And once you've identified the issue is that once you start here and you cross, well, that's when you start running into issues. And you can see that. It's not, is it exact? No, nothing's ever exact. But once you see that, you can't unsay it, in my opinion. You can start just seeing them over and over again, right? And it's nothing to do so much with the line, but the change of trajectory. The trajectory change, of course, is something that you're going to want to pay attention to. See the bottom, right? So you always want to watch this. Is it changing? Is it not changing? How is it evolving? What can we learn from the spread? And I think it's very clear what you can see here, that the moment that we started to explode with smart money being bought and they couldn't get out fast enough and the spread crossing that zero line, this turned pretty ugly, pretty fast. So what we're looking for are cracks in that and seeing, are we seeing any kind of abatement? And the answer is we kind of are. We're starting to see something, not all the things, one thing. So if we look at this year, you're starting to see this little bit of sideways. Now, it's not the be all end all, but what we want, I don't care about breaking the line so much as I want the trajectory to go down, right? I want retail to start buying. And if we look here, we're starting to get a little bit of, okay, we don't have to get to this level. And again, this level is about a 2.5 to 5, right? To get to that level. Really, what did we get to? Right? So, okay, we're at 1.5. And of course you can go over this. Of course you can. It's rare that you're down this long. But what I'm saying is if we hit this level or we get up here and then we start to see something like this, where we start to point down. So we're going to monitor this. If we start to point down, okay, you'll note from here. And this is, again, this is a leading indicator. And that's why I like looking at it. So when people say, well, I don't really view it as a leading indicator, it doesn't matter to me. If you look here, right, and we're going down, when we started to drop in here, you'll note that we kind of went sideways for a little bit. Meanwhile, while this did what? Broke out and went down. So if this is going to drop before we break out, then I want to watch this very, very closely. And this is something I want to pay attention to. Feel free to comment below on this. It's one data point. We're going to get into some more data. And I do think that this is somewhat pertinent. I found a site. I knew of the site, but I want to show you where you can find this data for free. Now, the data in front of me, it's pertinent. And I just want to point some things out that you should be watching to see this. Because you'll be looking at a McClellan oscillator, or you'll be looking at some of these other indicators, and they're actually calculated by the data that's in here. And this data is free. And I just want to point some things out. So first thing I want to point out is when you're going through a correction, and this is a correction, this is not the end of the world, right? And we're going to get to that in a moment. But it's really important for people to get to that. But understand, if you want this data, just go to wallstreet.com. It's market data, stocks. You type that in and you'll find this data. And here's the advanced declining, and it's right here. And this will tell you the New York Stock Exchange. So what do you have? Well, this is pretty clear to me, but we'll go through it. So you have 1,900 that are up and you have 892 that are down. Okay, that's 2 to 1. So what you do is you divide this and you get a number. That's 2 to 1. That's healthy. Okay, you wouldn't have thought that today. Okay. The NASDAQ, would anybody have thought that the NASDAQ had more advancing than declining? Not a lot of people, right? It's important that when you're going through something like today, that you take a step back and look at the data. Because what people are trying to do is they're trying to time the capitulation, right? And we all know how that went today. If you're catching a falling knife. And I do that kind of trading. I will try and catch that knife, but I understand that this is everything. Okay, so I'm watching this all day and going, okay, well, I'll try today because eventually it will catch. You can't have more names going up and less names going down, and eventually the market not bounce, and your name is not going to bounce. It's just not going to work that way, right? All right. So, and then you can just see the total amount here of those names. The other thing that this will do for you is it'll break it down. And this is why I like all the data on one sheet. So new highs, okay, when new highs in New York Stock Exchange was 13, new lows 39. Well, that's not groovy. So that's not something that we want, right? We want to see the new highs over the new lows. And until you get that, you probably don't have something of a bottom, right? And that just makes sense if you think about it. If more stocks are hitting new lows than they're hitting new highs, well, how can the market sustain itself and go higher? It can't. Now, this is where it gets interesting because you see this 34 of new highs and you see this 210. When these numbers start getting so skewed that you're at 8 to 1, 9 to 1, okay, that is signs of capitulation, meaning that right here, so when you take a look at this, something like this would be roughly 7 to 1, right? So you're a little over here on what would be the norm, whereas here you're at 2 to 1, right? 3 to 1. So if you go here, it's a little over. So when you get to an extreme reading, you want to pay attention. What else is kind of neat about this? Look at these readings and then look over here at share volume. It'll give you the total volume on shares and then, well, on the share volume, the advanced declining, well, that's 2 to 1, okay? And so that's kind of interesting. So you're telling me that even though we had 8 to 1 down, right, or 7 to 1 down, we had more volume on the buy side than we had on the sell side. So by looking at this data, you're getting a look at the internals of the market, and then you can utilize that. So like if I was looking at this on Friday and the market was a disaster, which it was, and we look at this data and go, well, this is down, this is down. Well, this all makes sense. But when you start seeing things like this, up volume versus down volume, you want to pay attention. If your advanced decline is 2 to 1 or even 1 to 1, you want to pay attention. But there's more things that are worth pointing out. Now, I'm going to give a couple ways, and these are not all the ways, but these are a couple ways that I use to determine, is this getting tired? Meaning, are they getting exhausted from selling? Now, if we look at what's in front of us, these are just the cues that I'm using, and below is just the McClellan oscillator. And what I've done with it is I've taken it and I just put it in histogram form. I like histogram form better because I want the data from the week. You can change this over. I don't believe there's an, on TradingView, I don't believe someone set this up in histogram form already. So I might set this up as a script, and if I do, then I'll just post it in one of the pre-market lives so that people can look at it. But what we're doing is I like looking at that data because that data tells me what I need to know. So if I look right here, it's going to tell me a couple. How deep is this? And what we should probably do first is just review what this oscillator is. So it's a market breadth indicator. And really what you're looking at is advanced versus declining issues on a stock exchange. Okay, and it doesn't matter which stock exchange you're using, but you're going to want to watch this. So because you want to see what's advancing, what's declining, right? If you start to see it excel, then it's going to get worse. If you start to see it stopping getting worse, then it's going to get better. I mean, it's not too complicated, right? As far if you don't have declining issues, then you don't have a problem. So it's not that hard. So don't overcomplicate this. And I'll show you that I don't really use this for peaks. People will use this for peaks, but if you overlay it, I don't think it does a good job of that. For me, on the peaks, it usually tells me that the advancing is going to increase and just keep going. On the declining side, it tells me that we've bottomed. So it doesn't really tell me, so I'll give you an example of what I mean by this. So take this peak, for example. That's not telling me that we've peaked. Right? What that's telling me is that we're probably going to keep going. That's how I use this data. Because if you're going to advance, you're going to keep advancing. If you're going to decline, you're not going to keep declining. Why? Because you constantly have buyers in the market, right? So again, when you buy constant, meaning maybe not today, maybe not in a week, but in a month, you're going to have buyers back in the market at some level. So if we take this mark right here and we look at where that mark takes us over this period of time on the cues. And again, what we're looking at here, McClellan oscillator is just a market breadth indicator, and it's based on the numbers between advancing and declining lines. So if the advancing lines start to get better, what's going to happen? Right? You're probably going to start leveling off if you think about it that way. Okay. And we're going to go through some other indicators that I use as well. But as far as first blush, meaning like what is the first chance that you're going to get that you might see some signs like, hey, you might want to start paying attention to that. And that's what you're looking for. Why? Especially with the NASDAQ, because you're going to want to find that reversal day, because when they reverse, and they always reverse. They have for 100 years. If they don't reverse, we don't have anything to worry about anyway. But what we're going to see here is when we just drop that level down, we can just see how steep that level is during that period of time. And again, all we're looking at is advanced declining, and I'll show you how that I use this. But if I just go and mark these levels right here, and what we've done is gone back about 3 years. And during that period of time, you're going to get a couple dates here on where we've been at this level. And that's usually what I do. I usually mark a previous level. And then from marking that previous level, I can just say, okay, well, what happened in here? And so then very simply, you're just pulling it back down. All right. And I'll show you why I mark where I mark in a second. So then I look at this and go, okay, well, I got to throw this out the window, right? People say, well, why? Well, you had 1.7 trillion ejected in the market. People were buying NFTs and thinking they were actually buying something of value, right? Everything was skewed because the Fed was just injecting money like it was, I don't even know, going out of style. So we can't really look at that level and say that we have something. Even the unwind of that makes it very difficult, but we're going to use the unwind because I think that shows like any unwind would. So you can see the peak right here. And again, where these are marked, I'm going to show you now, is I'm looking at not only the drop, I'm looking at the turn. So where is the last peak? And what is this peak telling us, just so we get this? So this is where the declines outweighed the advances the most. And really what we're doing is just looking at declining issues, advancing issues, declining issues. Okay, it's not based upon the volume like we just showed. It's based upon advancing issues versus declining issues. And you would just say, well, that should be the volume. Well, not necessarily, because you could still have more declining volume on one name, right? So this is taking issues. So that's why it's breadth of an indicator. It's not volume, it's breadth, because it's based upon the number of stocks that went up that day versus the number of stocks that went down that day. It's not a high-low, so just understand that, all right? So we're waiting for that turn. So, all right, so we get that turn, and then what we're doing, and I'm spending time with this on purpose because this is really like the first thing that I will start looking for that will tell me, okay, it's coming. There's a bounce coming. We just don't know when, but we're starting to set up, so let's start looking. And so we start to see here and go, all right, well, what did that really get us? Well, that got us a couple days. All right, what did this get us? A day. And then we came back, retested the low. But what did it do? Well, that put the low in. And then we can get into these divergences later, but divergences are real. We traded them. I traded them on the long side the other day, even on Friday, and I did quite well trading divergences. I'll walk through a trade on that later. But you can see how you're dropping here and how this divergence is actually rising, right? We can all see that. And that actually was the bottom of the NASDAQ, if you take a look at that. And you would have been able to determine that this could possibly be putting a bottom in, quite frankly, just by that divergence. But let's keep going. We'll do that another day. So if we're looking right here, apologize for the scratchy voice this morning. Don't know what's going on with it. But if we take a look right here on March, okay, well, that clearly marked the bottom. And this is a pretty healthy market. Now, what do I mean by health? You've been basing for a while. You work through all the excess of the worst Fed in history, right? So you've come through all that. I guess I'll tell you how I feel about them. And then what you're seeing down here is you're seeing the same thing. Okay, well, we bottomed and we bounced. It does not mean that you're putting in the bottom, right? But this, again, is telling you a story. You can see the divergences here, and you can see how we're rallying up, right? It's not feasible for that to continue. Like, it's not feasible for this to continue. I'm spending a lot of time on this particular indicator, and people just refer to it as an oscillator. I don't really care, because there's real value in this. It determines the breadth of the market. The best traders in the world that are looking longer term, they always would look at breadth, whether it was breadth thrust like Martin Zweig, rather. I'm not going to have time to edit this, but like Marty Zweig, I've gone over his breadth thrust a couple times. That's what you want to look at, because that determines the health of the market, right? All right, so what do you have here? You have another divergence where this is rising and then this is dropping. We can get into that. But what do you have here? You have the exact opposite. You have a negative divergence where the advancing issues are going away and what's happening? You're breaking. So while we're looking at this and while I'm explaining how I use it, it's really important for me to just lay this out there. This is a negative divergence. So while we're setting up to bounce, well, how can you say we're setting up to bounce? The advancing issues are getting stronger. It doesn't feel like that because we just watched SMCI and NVDA get taken to the cleaners, and people will think that's the end of the world. It's not. It's just this is the new standard. I'm going to spend time on that the more I'm thinking about it, because I think people are very confused here about what's going on. But we spent time on understanding, the equity premium, and I think that's important. But you just have a very simple trend line here, and then this becomes your control bar. If you watch these videos a lot, I really like control bars. But what's this telling us? Well, there's a bounce out there. We just don't know when. And we certainly don't know for how long. Just like there was a bounce here, but it wasn't just as steep as that. So this is the McClellan oscillator now. There's a website that you can go to as well at TradingView if you can't find this on TradingView, and I'll create the script, but I don't think the histogram's on TradingView. I couldn't find one. Let me find the website really quickly. I think it's called marketinout.com, and it's free. So I'm always trying to find free sites for you guys so you don't have to pay for things. Marketinout.com, and they will have the oscillator in there, and you can just take a look at it from there. But I do want to explain a couple things here the more I'm thinking about it. Before we do that, let's go through one more thing that I utilize a lot. Now, a lot of people are familiar with MACD, and I use MACD a lot on longer time frames to get a true sense of what's going on with the market. I find great value in it for the crosses. Same way I use the McClellan Summation Index, which I'm not going to bore everybody with today, but I do use that as well. And why? Why am I not going to do that now? Because they're going to be longer term indicators about the health of the market. And frankly, right now they're bearish. And we can look at them in later videos this week if you want to go over them, and I can tell you how I'm viewing them. But for me, what I'm trying to do is I'm trying to get people ahead of what I think is coming. In other words, you're going into corporate buybacks next week, you're going into earnings next week, and now expectations have been reset. We know that the earnings risk premium might be bottoming. So what we're trying to do is say, okay, I see us selling down, and there's a saying, they come for the generals last, and we're going to talk about that in a moment. Doesn't mean you're just going to miraculously go back up. But the way that people will use the MACD histogram, and I'm not going to suggest that you don't use it that way, I just don't find the same value in it. So what people will do with the histogram, and let's talk about what the histogram's doing. The histogram is measuring the difference between the MACD line and the signal line. The histogram is measuring the difference between the MACD line and the signal line. So if you look at a normal MACD, you're going to see that, right? You'll see those breaks. All right. So what is this telling us? Well, people will use this and go, oh, I'm just going to use a divergence right here. And that's a negative divergence. And therefore, this surely is going to crack. And I'm not saying that there's anything wrong with that if you're a long-term investor, but how'd that go, right? So like my point being, I'm going to miss out from November on because I have a negative divergence, or I'm going to say, oh, well, here's the negative divergence, or here's the negative divergence, but this is a positive divergence. I'm not saying to not use it. If I want to get into divergences, I'm going to use something a lot faster, like RSI. RSI is a lot faster. Rate of change is a lot faster than it takes for these two lines to get to where they need to get to, right? McClellan's a lot faster. It's instantaneous. Boom. Here's the advances. Here's the declines. This is two lines predicated upon a set of data, and that data doesn't really turn over very quickly. So that's why it's so important when you look at indicators to understand what they are, because then you can utilize them to your advantage, right? Just like we did smart money, dumb money. We're using that a little bit differently than they're using it. Same with the equity risk premium. If you noticed, we're using it a little differently than they're planning for us to use it. So what we have here is we are at a point where we are just not really going up, are we? So we're still dropping off a cliff. So for me to even say day one that we could bottom, or that the NASDAQ could bottom, or that we could bounce, I need a change in color. And I'm not the smartest bulb in the world, so what I do is I just use the color changes because, oh, I'm blue, oh, I'm green, right? As the simplest you can make anything, the faster you can make a decision, right? The more you know something, the faster you can act. And we all know that speed in this market is everything, right? You're either quick or dead, period. There's no in between. Everything you're doing in this kind of environment should already be thought out. Oh, it should always be thought out anyway, but in here, there's no time for games. You'll just get destroyed as people are starting to see. So it's something I try to really hammer home in the community. Anyway, you see how you're there? So I don't have any signal like here. And then you go, well, do your silly signals even work? And then you come here and go, I don't know. Let's take a look. Did that flip work? Did this flip work? Did that flip work? And what I'm looking for is I'm not looking for, did I go and take out highs? What I'm looking for is, did I stop going down? Because if I stopped going down, then that means I'm in a position where I could look and say, maybe we're going to bounce here, maybe we're not, but I sure know that if I'm short at that point, in high beta names, I better reevaluate my life, right? I better look at those names and say, hey, do I really want that kind of risk here, right? And you could look here, you could look at the false one here and then say, nope, you know what, we're going lower. I don't want to cover. I covered here, but you know what? I might have been early. Maybe I'll put them back on. Again, nothing's perfect. Anyone tells you they have a perfect system or there's no such thing, right? Or you're fighting for inches. Hopefully people get that. Then you look at something like this and okay, well that did mark the bottom and we did break out. And maybe we could use other indicators to make that even better. So when I look at something like this, I have no signal here on the NASDAQ that is even remotely suggesting and correlating to what I just saw on the oscillator from McClellan, right? So it's very difficult until Monday or Tuesday when I may get the blue to say that, hey, we're bottoming. And we're going to get into some stock names here today very quickly. And I want to show people how they should manage a position because what's happening, I'm seeing a lot of people, even in the community, they're getting in positions, they're getting out, then they're re-entering. And then when they're doing that, that's when they're starting to lose the profit. So I want to get into that a little bit on how to trade into positive slippage, because this is a real issue. It's not the trade that's the issue. That from what I'm seeing with people, it's the idea that they don't know how to manage the trade properly. There's nothing wrong with that. It's a skill set like any other skill set. So it's not hard to learn. It's just the repetition. So we could look here again at the SPY, the same thing. Are we seeing any sign of this whatsoever that is indicating we're in a position here that we need to pay attention to, that we're going to bounce? And sadly, the answer is no. And this is why I'm not really crazy about divergences here, right? You can see this divergence right here. And, what did that get us, right? I mean, could you imagine selling that divergence and how much of the market you just missed? I mean, that's why when people are sitting there predicting a crash, if you can't tell me the lottery numbers, you can't tell me what's going to happen the next day in the market. It's really that simple, in my opinion. So if you get this, but you need to understand why. Not that this time it's different, but why you need to pay attention to this and what this truly means. Now, let's deal with reality. And the reality is that a stock market correction happens a lot more than people think. And we have the social media that keeps calling for the crash. And I'm going to show you how often a crash is. Since the 50s, this is from Kiplinger. Since the 50s, the S&P has experienced 38 market corrections. And the market correction is considered a decline of 10% or more from the recent closing high. Now, people want to go out and say, oh, bear market, bull market, bear market, bull market. It's exhausting. It doesn't matter what you call it. Call it a blueberry. It doesn't matter. What you have to understand is that this is really common to just drop 10%. Now, what you need to understand by that is the rule of three. And I'm just going to explain it very quickly for time's sake. And we can always go into it more in other videos if it's of interest. But the rule of three is simple. If you have an index and that index drops 10%, you're going to have a sector. So in other words, the index drops 10%. You're going to have a stock index, right, that drops that much. You're going to have a sector, say semiconductors, that's going to drop 3 times that. All right, so let's say the Nasdaq goes down 10%. You'll see that the sector 3 times that. Off that, meaning 30%. Off of that, you will see stocks off that correction that get destroyed. They will drop. Some of them will never come back off that correction. Okay, it's just the way it is. And so when you get and you understand that, it'll start making sense. That's why you start gravitating towards the leading names on bounces. You don't gravitate towards the one that got hit the most. You gravitate towards the leading names, the one that got hit the least. Please remember that. But understand, this is very common. This happens every 2 years or so. Now, people are not used to this because they had the Fed babysitting them for a couple years, right? And then on top of that, you had low interest rates. And I'm going to explain why we haven't seen this and what a crash really looks like. So to start with, and this is just very simple, this is just accurate data. Since 1900, these are the crashes. So the idea that one's going to happen on a Monday or Tuesday next week, maybe sit down, get a cup of coffee, and just see what actually happens, okay? Because I love these two. The rich man's panic, the general panic. Okay, we don't have World War I or III yet, okay? We don't have influenza right now. We're not in a depression. We don't have a war, right? We don't have a Cuban Missile Crisis. So when you start looking at what are these things that trigger, okay, the dot-com crash, you're so far away from this. It's not even funny. We don't have a housing crisis, and hopefully we don't have another pandemic. So when you start looking at the reasons why all this happened, we don't have any of that. And I'm not saying that it still couldn't happen. There's not something under the hood, right? We remember regionals a couple of years ago. Like, no one saw regional banks coming into the issue. But here's the problem. And a lot of people don't get this. And I was doing an onboarding call yesterday with somebody, and it was just really a fascinating conversation for me, actually, because they think that because they've been trading for a while that they understand this stuff. And then you forget what you don't know, right? So it's crazy, the stuff that you forget over time. But if you go back from '08, you had 0 interest rates. And the first time that you had any interest rates whatsoever, people just panicked. They lost their noodle. And then we had the pandemic, and then we went back to 0 interest rates. So for a period of time, people are used to 0 interest rates. Okay, and that's not realistic for you to have 0 interest rates. And that's the Fed funds. What's more realistic is when you go back over time and you go from 55 on and go, oh, why do you care about this? Because if you have a name like NVDA and you have this name on margin, for example, you have a margin rate, okay, and you're paying margin on that. So not only are you losing money, you're paying interest to lose money. The volatility of the market will be extreme. compared to what people have seen, because before you didn't have an interest rate. Now margin debt is a real thing. And so what you're going to start seeing again is we're going to start looking at margin debt in regards to the stock market, margin debt in regards to GDP, because the volatility is going to increase because the margin is real. So you don't want to be on margin when things go down, because not only are you doing this and losing more money, but you're having more issues based upon that, right? So people need to get that. And I thought it was definitely important to spend time on it, because everyone's saying, oh, we're just going to crash and this is all over. And then 2 months from now or a month from now, if it bounces, which I do think it does, what we're going to see is that these things just start trading back up. So instead of looking at the market like NVDA dropping or SMCI dropping, going, oh, it's the end of the world because they didn't pre-announce that they were going to triple again, let them drop, let them set up again, and we'll find spots. Let me show you a way to stay in some of these trades and how to manage them effectively, or one way to manage these effectively. Now, I want to talk very quickly about a process. Process is called positive slippage. You want to master trade management. All right, so this is a trade that we did, and it's important to get why I'm showing this trade. What I see people, the common mistake, it's funny they actually have the word mistake here. The common mistakes people are making with these kinds of trades is they're putting them on, they're getting out too early, and then they're putting them back on, and then they're either not making as much money or they're losing money with the trade, because then the second trade doesn't work and then it encapsulates that amount of money, right? And we've all been there. We've all done this. I certainly did it when I was younger, or newer to trading. But there's important strategy here. And so what I want to do is I want to walk through it. So if you're newer, this is an account that I have linked to the room, and the room's when we do trades, and I'll show the timestamps of when we did this on the actual stock itself. But I want to get people to actually see how this stuff is executed. So I will speed this up for time's sake, but what I want to show is I want to show when things are executed and how they're executed and how long I'm staying in these. And what I did was I bought a bunch of puts on ARM. Now, we had this trade on the day before, and I'll show you that in a couple minutes here. But what's important about this is when we put it on, and let's speed this sucker up a little bit. So what we're doing is we're buying the puts when we get a clear indication that we should be buying the puts, right? So this is predicated upon the falling of the stock and the stock making a lower low. And we already had puts coming into this. And what I'm doing is I'm trying to buy more. And the reason is because I feel that this stock's going to come in pretty hard. And I have my reasons for that. And I'll go through it when we look at the stock. But what I want you to do is get the concept of how are you supposed to get out of your trades? And what you're supposed to do with your trades is you're supposed to enter at the right time. Now, once you enter at the right time, right, you put your trade on, and I want to be clear about this. This is less than or about 1% of this account, this trade that I put on. So if it went to zero, I'm going to lose 1%. So the first thing that people are doing is they're sizing their positions way too big for their account, right? They're making each one make or break. It's a huge mistake, but let's jump ahead here so that we're not here all day staring at this. So what we're doing is as it's going up, we're scaling out of portions. My goal when I entered this trade was to hold it for a week, and it's why I went out further on puts. So what I'm trying to do is I'm trying to stay in the trade, but as it's trading up, I want to scale out of smaller portions. Now, I tend to use 10 or 20%. You should use what you're comfortable with. I know guys that will sell 80% and move the rest to break even and then just leave it till they're 5 or 10 are the trade. That's not what I do. I want to lock something in. What you don't want to have happen, specifically with option trades, you don't want to be selling when they're breaking down. You definitely don't want to be that guy. Positive slippage is what you need to focus on, right? You want to be selling into strength when you're high-fiving your bros, right? You want to be selling into that strength. And what you do is you just keep doing it over and over again, right? So the stock breaks down, looks like, meaning because the puts are going up, so the stock's breaking down. What are you doing? You're scaling out into that again. I'm just pulling 20% of the original. So I always keep it around there. I don't move it and say 20% of what's left. That's not how I do it. I do 20% of just whatever the original is. I make it simple. And what you need to do with your trades is you need to see what level you're comfortable with. What you don't want to have happen is this. I'm going to stop for a second. What you don't want to have happen is you don't want to enter here. You don't want to have not pulled anything out when it's up and then reevaluate your life down here and then close them because they're break even. And I see so many people doing this where they're getting out when you have nothing but just regular volatility and movement, right? And we can get into how to determine if it's regular volatility or if it's not regular volatility, but we're going to have to do that another day. And that's very important. I look at that a lot. But once you see this, all right, so then you're scaling out. Let's just keep going with the trade. Now, I wanted to hold this. But we got to the point where I refer to it, is it just very simply got goofy. And the market got goofy at the end of Friday, I felt. We're going to go through some charts at the end of the day. But what I'm doing here is the same thing over and over again. Wash, rinse, repeat. I spike, everybody's high-fiving. Oh, we're definitely going to break. ARM's going to go to zero. I don't know what's going to happen, but here's what I do know. I do know that we're going to break out and we're going to retest. I know we're going to break out and we're going to retest. And what do we do over and over again until one of these retests doesn't hold? Now, at the end of the day, I made it clear, and I'll show you the timestamps in a minute here. But what I made it clear was, hey, I'm out. I had a really good day shorting a bunch of names and a bunch of stocks. There's certain names I held. I'll show you in a second. But what you're doing here is called positive slippage. It's going in your favor, you're pulling something out. You don't want to be the guy that's not getting out of some here, right? That's just been in the trade for 2 hours and then gets out here, right? That's who you don't want to be. And then because what people are doing is they're moving their stops down, right? They're protecting that. They're using a trailing stop based upon support levels. One, you don't really want to be doing that with equities, but you certainly don't want to be doing it with option trades. You want to be scaling out while the trade's working on extreme moves. All of these were extreme moves where it just happened super fast, right? And then candidly, it got way worse than I thought, but we're going to walk through the stock right now. I did get asked for an update on this account, so I'll just show you year to date how it's going, but there's a couple important things for you to get here. Look at the win rate. Right? So when you see the win rate of 52.76, and then if I go here and click through the dates, right, and we take a look at them, what's important about this? If I re-enter a trade, right, that's interesting. If I re-enter a trade, what's most important about that re-entry is this. I have a 48% chance or 47% chance of that trade not working. So once I'm in and I have a trade that's working, why would I want to go back and re-put that trade on and take that risk? Why wouldn't I just manage what I have to the best of my ability? That's why you want to work on your trade management and not care so much about the re-entry of the next trade. Now, here's the ARM trade. And the previous day, we actually bought puts. And we could see this for a couple different reasons. One, we saw the SOX breakdown, and we'll get into that in a second. But this is point of control, and you can see the point of control. Point of control is different than VWAP. Point of control is more powerful, in my opinion. That's the price where everybody owns the name. But you can see the break right here, right? From that line. So point of control, volume by price. I walked through Thursday how to draw this. And so if you take a look here, you broke down, but it was pretty clear to us what was going on with the trade. And that's why we got in earlier. And what we're trying to do here is a couple things. We're trying to stay in the trade, but we know that if semis got weak, that we knew that there was a huge seller out there from SoftBank. He was in the trade. He's made an absolute killing on it. He wants to lock it in. And it's all fun and games, and he can stay in it, and he can scale out slowly, right? And you can see what level he's actually getting out of until you start having the ASML news, the Taiwan semi news. And then it's time for him to go. And you can start seeing some of this as I'll just pop these in. So as I said, I promised I'd show the timestamps on the moves. So this is the first ARM position we had yesterday, and this is John while I'm trading live, just typing what's going on in the room. I can't type, trade, and talk at the same time, so I have someone that helps me. But you could just see right there that, if I get over that 5-minute bar, I'm going to close the short position. That was the original short position. So if you just came here and took a look at it, what I was looking for was this, and this was my concern on the day. You're seeing a lot of the fake breaks, right? So I want to close over the 5-minute. I didn't get it. Therefore, I never had to close the original short position, right? Which allowed me to stay in it and profit. I didn't get into that trade. I just got into the other trade. But you see where I'm going with this. And what you're doing here, so you can see, there's the alert for the room. 10:38, so we put it on, and I just think it's important to show the timestamps of what's actually going on out there. But what you're trying to do is you're trying to stay in the trade the whole time. Find this other one. Now what you're doing is you're evaluating your trade the whole time. So I'm posting where my target was. And what I'm saying is my target was right here. So now this becomes the question, and nobody knows the answer to this question. And this is really important for you to get. We don't know what's going to happen. We assume that this is support, but what does it do at that point? It tries to rally. And then what's it do? It breaks down. Now into this break, these are the kinds of breaks you want to be scaling out of, right? If you correlate these breaks, when everyone's cheering, you're getting out of them, right? You're pulling money out. You're not adding to them. If you were going to add to these, where you would do it, I actually shorted more here. So I actually shorted stock here. What you want to do is you want to short into these areas when you're going to get what? Positive slippage on your entry. Right? So what you're trying to do is you're trying to find the most optimal spot to put on your trade and the most optimal spot to get out. Remember, once you're in, okay? And then you want to put yourself in a position so that you're going to be able to get the best risk reward. So if you know that this was, and we just went through it like tissue paper, and then we tried to get through it again, and then we broke, then you know this is an area of interest, right? You could go through you could just say, look, oh, it's a bearish hook right here, up 1, 2, 3, down 1, 2, 3. I need to do another candlestick video. And then you just kind of go from there, and it is what it is. And what I wanted to do by the end of the day, I'm like, okay, look, I don't know if we're going to get a dead cat bounce on Monday. I don't know if it continues, but based upon the volatility and the size of this move, right? Like you start looking at these moves from a standards deviation standpoint, I just want to close. And candidly, you can see how this is even correlating to where my stops were, where I'm looking at this and saying, well, yeah, I'm going to scale out of some, but this is getting worse. I did not expect us to fall off the cliff this day. And that's a very important distinction, because what people are going to do is they're going to try to build a new model, a new trading process around the idea of what happened over these past 3 days. And that's just the kiss of death. You have to have a process and where you're holding a portion of the trade and you're scaling out as it's working for you, right? People will look at that trade and say, oh, you could have made so much money holding it. Yeah, but you don't know that you're going to get this, right? You don't. And anyone that tells you that, ask them what tomorrow's lottery numbers are. Right? Because that's the probability that they know that today's the day that this is going to happen. Nobody knows. Hope this was helpful. So I hope you found that helpful. And what I'm trying to do here, guys, is I'm trying to present as much information as I possibly can and pack it in. So your comments are appreciated on what was most helpful, what was least helpful, or what you want to see. But let's get to it. So if we just look at the SOX right here, it's very difficult for anybody to say that that is going to hold. But that is a pretty fast move in a very quick period of time. So how I like to determine this is I'll just look at bands and go, okay, I'm popping out of a third standard deviation band. So if and just so we understand this, so first standard deviation, there's a 67% chance you're going to trade in that range, right? Second, I can go here and click these off real quick. So first, there's a 67% chance that you're going to stay in that range, okay? So when you pop out of that range on a one time, you know what that is. Then you go here and then you go, well, what's the chances of staying in a second? It's about 95. So when you pop out of that second, that's pretty rare too. And even if you look at that, when you're popping out over here, you usually revert back to the mean, right? That's usually what you do. You pop out, then you revert back, you pop out, you revert back. And these usually provide areas of interest, right? That's why you see a lot of people trade the 20. They don't really understand that they're trading volatility on when it works versus when it doesn't work. But anyway, you see how this is going? All right, great. So then what you want to see is this, is the third. This is the one I use. When I'm breaking like a third, you have to think about these as rubber bands that they could snap back. So when you see something like that, it doesn't mean, oh, I got to go out there and I have to short. For me, I'm looking at that and going, yeah, we could definitely go lower. And yes, of course you can go lower, but there might be some kind of snap back. So is this an optimal place to short? Probably not. Now, what I'm using and leaving the third on is you're looking for turns. And what I mean by that is, so if I look at the financial sector, well, we came to that third, right? And again, I want to be real clear about this. I'm leaving the third standard deviation on right now. And so what we're seeing is we're starting to see that turn. Now, I was short a bunch of these names, and I'm going to have to really start reevaluating what I'm doing here, right? Because they were doing great, and now you're starting to see them turn. So what I will do next is I will start going through these names. I'm giving you exactly what I'm going to do this week so that you can do it for yourself. And I will start looking at these names and going, okay, who's above the 3, the 5, and the 8? And you go, oh, well, JP Morgan is. And I know you can't see this very clearly, but I don't have time to redo them. But, oh, JP Morgan's starting to do that. Oh, is Goldman? Oh, yeah, Goldman's above the 5, and we just had a retest of the 5, and we held it. Oh, okay. So now you're going to start looking at these names a little bit differently, right? So what we are starting to see, and if you take this and you start tying this into like the advanced decline line and new lows, new highs, we are seeing financials start to hold. Well, that's interesting. That's right around the same time as what? The equity risk premium started to what? Go sideways. All right. So we are seeing areas of interest. So you might start looking at like XLV and saying, well, is that going to hold? Is that not going to hold? And that's why everything dropped, right? Repricing. And then you look at XLV and you're like, okay, well, we are holding that third and we're kind of going sideways. Now we're into the second. Do I really want to participate in that? Probably not. And you're seeing XLB, same thing, hit the third. So then you get to a point with this, even looking at the cloud, right? Cloud stocks, and they're hitting that third, and then they're just keep going. So when we start to look at this stuff and we start to look at it through the lens of the NASDAQ, and you start realizing that the NASDAQ is at a third standard deviation, right? And then we just kind of go look at the SPY and go, oh, well, we're at we hit that third standard deviation. Now they're just walking us down. So that's not warm and fuzzy at all. So can this bounce here? The answer is yes, but we've only seen a couple signals that it's setting up to bounce, really, the McClellan oscillator. Other than that, no. But we must be cognizant of where we are in regards to this move to the downside. That doesn't mean you're miraculously going to take out highs as we've walked through this video, but it does tell you that you are at a spot that if we did bounce, you shouldn't be too surprised by that. What I would do is I would focus on what's working, right? That's where I would go because that's where the money flow is going to go with the high relative strength. And so what we are starting to see is we are starting to see the energy names start to hold significantly better than they once did. So you could suggest here that, hey, you might want to look at what? The energy names. That might be a good spot for people to start taking a look at, start looking there. What else? Well, this Argentinian trade that everyone thought was dead doesn't really seem like it's dead. And then if I go and take a look at some of the Argentinian names, they seem to be holding that median line on the Bollinger Bands just fine, don't they? So you start running through those names, and that's a really interesting spot. And then you can just see how like even BBAR at one point was up 7% on a day when everything else was down. And that kind of ties to the KRE situation we were just looking at, but also at the same time, you need to be cognizant of some things. With rates going higher, it's very difficult to suggest that the home builders are going to miraculously turn around or that car dealers are going to miraculously turn around. They could continue to go sideways or grind because that's the interest rate trade, and that trade still needs to unwind. That's it.